What if mastering money isn't just about formulas and spreadsheets, but understanding the strange ways our minds react to wealth? It's often more psychology than math, shaping our financial fate. Everyone sees money through their own unique lens, shaped by their upbringing, experiences, and historical context. Your approach to risk and savings is deeply personal, not purely rational. Our personal experiences with money, especially recent ones, heavily influence our decisions. A childhood during a recession might make one super cautious, while a stable economy encourages bolder moves. Success isn't just hard work. Luck plays a huge, often underestimated, role. Recognizing this fosters humility and prevents judging others too harshly for their struggles. Conversely, failure isn't always laziness. Sometimes, it's just bad luck. Understanding this helps us approach both success and failure with less ego and more empathy. The most powerful financial force is compounding. Small, consistent efforts accumulate into massive results over time, demonstrating the quiet power of patience. True wealth isn't built overnight. It's a marathon, not a sprint, where patience and consistent saving far outweigh attempts at quick, high-risk gains. Riches are visible displays of money, expensive cars, big houses. Wealth is invisible, hidden in savings and investments. One is a party, the other is power. Saving money isn't for a future purchase, but for future independence. It's about gaining control over your time and options, not just accumulating stuff. Knowing when enough is crucial. The desire for more can lead to ruin, pushing you past your safe limits in pursuit of endless growth. The story of Rajat Gupta, who went from Goldman Sachs board to prison over insider trading, illustrates the devastating consequences of not knowing your boundaries. We often make financial decisions based on emotion, trying to rationalize them later. Understanding this emotional core is key to better decision-making. The financial world is unpredictable. The single most important rule is to survive, to avoid ruin. Building a margin of safety is paramount. Your financial strategy should be robust enough to withstand black swan events, unforeseen calamities that can derail even the best plans. Most of your long-term success will come from a few key investments or decisions. It's not about being right all the time, but being right significantly when it matters. Don't get discouraged by short-term losses. Historical data shows that market growth is often concentrated in a few incredible days, which you must be invested for. The highest form of wealth is the ability to wake up each morning and say, "I can do whatever I want today." Financial freedom grants autonomy. This freedom doesn't mean eternal leisure, but being in control of your time, choosing how and where you spend your energy, rather than being dictated by necessity. When you see someone in a fancy car, you rarely admire them. Mostly, you imagine yourself in that car. Wealth envy is a trap. Avoid judging your success purely by the visible possessions of others. True financial peace comes from within, not from external validation. Pessimism often sounds smarter and is more attention-grabbing than optimism. However, long-term history favors optimism and growth. While financial markets face downturns, humanity's collective ingenuity and relentless problem-solving drive long-term progress. Never bet against human adaptability. Always build a margin of safety into your financial plans. Expect the unexpected, because life will inevitably throw curveballs. No plan is immune to error. Acknowledging this helps you prepare for setbacks and avoid catastrophic losses when things inevitably diverge from your strategy. History is a guide, not a crystal ball. Past market behavior offers context, but never guarantees future outcomes. Remain adaptable. Financial markets evolve. What worked in one decade might not work in the next. Your strategy must be flexible enough to adapt to changing landscapes. Market volatility, declines, and corrections are not penalties. They are the price of admission for long-term growth. Expect them. Don't fear them. The cost of market growth isn't always monetary. It's often the emotional toll of enduring uncertainty and temporary losses without panicking. Acknowledge that your past financial decisions, good or bad, were made with the information and emotions you had at the time. Don't let regret paralyze you. Your investment strategy should consider your personal goals and risk tolerance, not just historical market trends. It's about building a future that works for you. Money moves based on rules, taxes, inflation, economic cycles. Understanding these empowers you to navigate the system more effectively, rather than fight it. Inflation quietly erodes your purchasing power over time, A dollar today won't buy the same tomorrow. Factor this stealth tax into your long-term planning. Be skeptical of financial experts who promise certainty or predict the future. The best advice often comes from those who openly admit market unpredictability. The most successful investors are often the most humble, understanding that markets are complex adaptive systems, not perfectly predictable machines. True wealth can also be measured by how much you can give back to others or use to improve the world. Money can be a tool for good. Your financial habits not only affect you, but can shape the future for generations to come. Be a good ancestor with your money decisions. Money can buy happiness up to a point, fulfilling basic needs. Beyond that, more money doesn't always equal more joy. Focus on what truly makes you happy. Investing in experiences, relationships, and health often yields far greater returns in personal fulfillment than accumulating material possessions. Use money to gain independence, not to signal status. The peace of mind from financial autonomy far outweighs the fleeting admiration of others. True wealth accumulates quietly, often unseen. It's what you don't spend, what you don't flaunt, allowing compounding and time to do their magic. Ultimately, personal finance is less about what to do and more about how to behave, developing sound habits and mental models for decision-making. Before you invest, understand why you want more money. Is it for security, freedom, or something else entirely? Your purpose drives your strategy. Distinguish between taking calculated risks for growth and succumbing to pure greed. One is strategic, the other often leads to irrational decisions. Fear is a powerful motivator, often leading to panic selling or missed opportunities during market downturns. Recognize it, but don't let it control you. Conversely, some of the greatest wealth is built during periods of market turmoil, when others are fearful. This requires courage and a long-term perspective. Focus on factors within your control, your savings rate, your behavior, your time horizon. Ignore the noise of unpredictable short-term market fluctuations. Endless pursuit of financial news can be detrimental. High-frequency trading and constant updates lead to emotional decisions, not better outcomes. Often, the simplest financial strategies, consistent saving, diversified low-cost index funds, long-term holding, outperform complex, active trading. Having a healthy cash reserve, even during low-interest periods, provides peace of mind and acts as a buffer against unexpected expenses. Ultimately, money is a tool. Its true value lies in what you choose to do with it, not how much you accumulate, but the life it allows you to lead. Global events, from wars to pandemics, significantly impact economies. Your personal financial journey isn't isolated from the broader world. Flexibility in your financial plan is a superpower. Rigid plans break under pressure. Adaptable ones bend but don't snap, allowing you to pivot when necessary. While your financial journey is personal, observing the successes and failures of others can provide invaluable lessons without you having to make the mistakes yourself. Time is your most precious asset. Use your money to buy back time, allowing you to pursue passions and spend it with loved ones, rather than earning more. Investing in your own knowledge, skills, and health can yield returns far greater than many traditional financial investments. You are your greatest asset. Short-term market forecasting is often futile. Focus on the long game, maintaining your investments through ups and downs, and let compounding do its work. Building financial resilience means having enough flexibility and a margin of safety to absorb life's inevitable shocks without derailing your entire plan. Develop your own personal philosophy of money. What does wealth mean to you, beyond the numbers? This guides your decisions more than any spreadsheet. Remember, money is a human invention, and human behavior drives its dynamics. Understanding ourselves is paramount to understanding our finances. The best time to start applying these principles was yesterday. The second best time is today. Small, consistent steps lead to profound long-term change. What psychological insight about money resonated most with you? Share your thoughts in the comments below, and let's continue this journey toward healthier financial habits together.